Hey, this is Phil Denfeld, and this is your Spring 2015 Mortgage Update. So I've put together a quick presentation to share with you some insight and outlook on the spring market. And starting with that, I'd like to discuss interest rates. So in talking about mortgage interest rates, it's helpful to look back in time and see where we've come from. Historically, since the 1970s, rates have gotten better. The 1980s were an anomaly and we had rather high rates in the 80s. But you can see here this $500,000 mortgage over time in the payment. And in fall of 2014, with an average interest rate of 4.01%, that yielded a monthly payment of $2,390. Certainly more affordable than in either of the previous decades that I'm showing. Now, the next thing people always want to know is, well, where are rates going? Well, here's an example of projections from the four major players in the real estate and mortgage world: Fannie Mae, Freddie Mac, the MBA, which is the Mortgage Bankers Association, and the NAR, or National Association of Realtors. And you can see that across the board, if you look at the averages, as we move through the year by quarter, rates are projected to increase, and by the end of the year, to maybe be in the mid 4% range at 4.4% according to this projection. So certainly that shows that as you wait, things are going to get more expensive simply because rates go up. But here's another way of looking at that. I hear all the time from clients certain comments that I thought I would review with you here today and share with you how I might answer those. So take a look at these comments and maybe test yourself on what you think the right answer is. First comment would be, it takes 20% down to buy a home. Well, in actuality, that's not true. It's false. We have many loan programs that offer buyers an opportunity to put as little as zero down, with ranges all the way from 20% down to zero. For many first-time home buyers, there are 3 and 3.5% loan programs, but you don't necessarily have to be a first-time home buyer to qualify for those. And if you're a military veteran, VA offers 100% financing, and even for some first-time home buyers, we have some zero-down loan programs. So the best thing to do is to have a qualified lender look at your particular situation and help them analyze where you think you might fit into one of these down payment scenarios. The next comment would be, my credit isn't good enough to buy. Well, my answer to that is, are you sure? You know, we have many loan programs for low credit score clients. Not only that, we have ways to help you work on your credit, give you some pointers, some insight, some things that you can do on your own to improve your credit score. And often, it doesn't take that much to move a credit score into a range that would allow you to purchase. So the best thing to do is talk to your lender again, have them look at your credit, and you can also do that yourself by going to annualcreditreport.com. That's a government-sponsored site that allows you to pull your credit once a year and to take a look at it and see if there are things that are reporting incorrectly. The last comment I wanted to discuss, and this one requires a little bit more insight, and that is, I'm going to rent so that I can save a little more and buy next year. Well, what are you doing when you say that? Let's take a look. Here's a chart that talks about the buyer's purchasing power as time goes on. Let's look at a $500,000 mortgage at today's rate of 3.75%. If you look at that, it yields a monthly payment of around $2,316 in principal and interest. Let's look at that same mortgage payment as rates go up. Look at how it impacts affordability. If you're trying to keep that mortgage payment in that $2,316 range, if I look at my pointer here, there's $2,327 at 4%. Here's $2,337 at 4.25%, and so on, until we get all the way up here to $2,347, which is actually slightly higher, but at the rate of 4.75% than it was at 3.75%. And now you can only afford a mortgage of $450,000. A $50,000 decrease that could happen as little as little as 9 months based on our rate projections that I went over just a minute ago. Now, another thing to look at here is the percent change in the price of homes over time. Here's a chart to show the year-over-year percentage increase in home prices by region around the country. And you can see here that in the South Atlantic region, which encompasses Virginia, Maryland, DC, West Virginia, the surrounding areas, we've looked at an average increase over the year of about 5.07%. Certainly nothing to sneeze at. It means that the price of homes are increasing. That's great for you as a home buyer because the thing that you're going to buy, that asset that you're purchasing with a new mortgage, is going to increase over time. Now, I'm not going to sit here and guarantee you it's always going to be 5% or more. It could be less, but it also could be more. But in general, I think we've come out of the low times of 2008, 2009, and we're certainly in a much healthier housing market than we were in the past. Now, I wanted to also talk about the waiting and renting versus buying. Let's look at a $500,000 rental property with an average rent of, let's say, $2,500. To buy that same $500,000 home, putting 20% down at an average rate of 4% and average taxes and insurance, you're going to yield a monthly payment of $2,735. But let's dive a little deeper into those numbers. Look at what happens with each monthly payment. You're going to reduce the principal on that balance, in other words, build equity, of a minimum of $637 a month, which increases with each monthly payment. At the same time, you're going to realize a tax benefit. If we look at an average tax bracket of 28%, you're going to get a tax benefit of $502 a month, a reduction in your taxable income. And lastly, you're looking at, if we project just a 3% average appreciation, and I just showed you a chart that showed on average over the last year we're over 5%. But if we look at a 3% average annual appreciation, that translates into $1,327 in additional equity each month, which brings us to a bottom line cost on a monthly basis of that $500,000 purchase of $269 a month. Yes, that's right, $269 a month. Now look, you still have to write that larger check of $2,735, but you'll be able to adjust the withholdings in your monthly paycheck so you bring home a little more money every month, and knowing you're going to realize the tax benefit and you're going to be building equity, home ownership certainly is a way to go. Why would you be paying someone else's mortgage when you can be paying your own and realizing the benefit of these other things that I've discussed? Lastly, I wanted to look at this another way. Take a look at the $500,000 mortgage we've been talking about and project a rate of 4%. That's a payment of $2,387. Now, with inflation or increase in price of the home, that same home may take a mortgage of $520,000 by the end of this year, and rates could be at 5%. If that were the case, the new payment would be $404.39 higher than today. Certainly something that you want to consider when you talk about possibly waiting to purchase. I'm here to help. I hope you found this informative. If it's caused you to have some questions, give me a call. Here's my contact information. Phil Denfeld. Call me at 703-293-6151 or email me at pdenfeld@fhmtg.com. It's been great talking to you today, and I again encourage you to reach out to me via phone or email, and I'd be more than happy to help you. And look for my summer update coming in the next few months. Have a great day.